Thank you so much for joining us. It's a great pleasure to have with us Max Ansbacher, President of Ansbacher Investment Management based in New York. Max, welcome.
Thank you.
It's an honor to be here and learn from you. You're a thought leader on option strategies, have been in the business for decades, pioneered option strategies for investors. Before we get into discussing the topic itself, tell us a bit about what made you interested to look at options and how you got interested in the investment business.
It's a classic story. I was around when exchange-traded options first were created in the 1970s. And my broker said, you know, you can pick up some extra money by selling calls on stocks that you own. So this happened to be in a time of a major bear market. So I was selling calls on the stocks and making money on the calls, but losing money on the stocks. And I asked him, well, can't we just forget about the stocks and I'll just sell the calls? And he was very reluctant to do that. He said, no, you can't do that. That's too risky. But I persisted, and finally that's what I did. And the money just rolled in. So I said to myself, this is really something I should look into. And I did. And I was a lawyer at the time. But I decided that this was an exciting field. And I wrote a book on options. It turned out to be the first book published in America on exchange-traded options. And once that book was published, I said, well, goodbye, legal profession. I'm going to go to Wall Street and make my career in options.
Now, the subject of options stirs up some emotion with different people, different investors. Often the perception is that this is a rather mathematical field and can be quite complicated. Help us perhaps break it down a bit, go into the basics. What is really at the essence of option strategies?
Well, the essence of option strategies that we use is one of the wonderful things about options is something called the strike price, which means you don't, at the end of an option's life, it's only worth something if it is over or under the strike price, depending on whether you're talking about a put or a call. So there is a time decay in options, and that's the key. You don't have to be able to predict what the market's going to do. I mean, you have to predict certain probabilities, but you don't have to say that it's going to go up to make money, for example, if you have a strategy that's bullish. You can make money if the market stays the same, because with the passage of time, actually every day the theoretical value of the option goes down. And if you were short the option, that is, if you've sold it, you will be making money. So this is a big advantage over, say, buying a stock, where you could only make money if the stock goes up. But you can't make money if the stock goes down. Whereas in our case, if we're writing a put on a stock or an index, we can, and often do, make money even when the market moves against us.
Now, help us understand what you saw in the market that has allowed you to devise the option strategy that you are using. Help us understand the inefficiency that has allowed you to profit.
Well, it took years and years. It didn't happen all at once. And I have to say that this example I gave of why I started out and the money was rolling in is not true today. It's not as easy to make money with options. In those days, before Black-Scholes had invented the formula for determining the appropriate price of an option prices were much higher than they should have been. People didn't realize that. But brokers thought that these new options were absolutely almost a miracle, because instead of buying a stock for $100, you could buy an option on the stock for as little as $5. And if the stock went up enough, you would make more money actually as a percent on the call than you would on the stock. So it seemed wonderful. But then people realized that, oh, if the stock stays still and doesn't go up, you lose 100% of your money on the call. So then the prices of the options started going down to more realistic levels, which we have today.
Can we talk perhaps a little bit about, from the perspective of an equity investor, what sort of benefits there could be to thinking about and employing options?
Yes, equity investors, it's very common that they sell calls on the stocks they own. Or you can sell calls on an index to duplicate a portfolio that you have. And what this means is that, in effect, you are selling future gain on your portfolio to somebody else. So you are, to a degree, taking away some of the volatility of your portfolio. For example, let's say you have a stock that's worth $100. If you sell a call with a strike price at $100 for $5, you've taken in $5. Now, if the stock stays the same, that $5 becomes your profit on this transaction. If the stock goes down below 100, you keep the $5, and you may be losing a lot of money on the stock, but whatever the stock goes down, you're going to lose $5 less than if you hadn't sold the call. Now, the negative, and there's always a cost on Wall Street. Now, there's no free lunch, as we know. The negative is that when the stock goes up, you have sold away the profit above $100. So if it goes to 105, your option would be $5, and the stock could be called away from you at 100. So you made the $5, but that's all. And above 105, it's still going to be called away from you at 100, and you would make your $5 above the price it was when you sold the call, but you're now behind the person who never did sell the call. So you're really betting against a major rise in the price of the stock. So depending on your point of view as an investor, it could be worthwhile because it reduces the volatility of your portfolio.
What are some of the misuses of that strategy that you see being applied by investors who perhaps don't understand the workings of the options market as well as you do, but look to options just really to complement their core competence in equities?
Well, getting back to covered call writing, I'm glad you asked that question, because brokers or advisors often overstate the benefits of selling calls. And what they say is, oh, here's a way to pick up extra cash. We're taking a stream of money coming in, and there's a 3% dividend on the stock, and you can get 5% a year in option premiums. You have an 8% return. That's not necessarily true. And if the stocks go up enough, you don't make money from selling covered calls, you lose money. So at the end of the call's life, and if the stock has gone up a lot, you have the choice of selling it out at what it could then be well below the market price, or having to buy back the option at a loss. So many people have been very disappointed. They thought, oh, this is going to release a lot of cash. But in a bull market, what happens is they don't want the stock called away because of the tax consequences. So they have to buy back the option. They sold this option for something like 5, 3, 2, who knows what, and now they're buying it back for 10. So that's a good way to use up cash. And you may have to put more money into your account instead of taking it out. And that's a rude awakening to people who thought they were getting a whole, a golden fountain here.
Now, if we think about covered call writing, would you say then, if we think about the various benefits that equity investors could gain, some of those benefits could relate to hedging, others could relate to generating income. What other strategies are there out there that would really be available to an equity investor? What's the
Well, the only
the...
one that comes to mind would be if they're worried about the market going down, you could buy puts on your stocks. And a put is an option that makes money when the market goes down, just to keep it really simple. So if you had a stock at $100 and you bought a 100 strike price put for, let's say, $5, the $5 you paid for that put would be lost. That is gone. But if the stock goes below 95, you are making back dollar for dollar whatever the difference is. So if the stock goes to 90, you can sell it for 95 and sell it for $5 more than the market price at that time. So it is a very good way to protect against loss. And because we have such a variety of strike prices, you can really determine how much risk you want to take and how much you're willing to assume. So if you say, well, I can take a 10% loss in a stock, you might buy the 90 strike price put because it would be a lot less expensive than the one at 100 or 95. And that would give you a guarantee that your stock could always be sold by you for $90, no matter how low the market price went.
So this is then a hedging strategy?
It's absolutely a hedging strategy, and many institutions use puts. Hedge funds frequently do. Because you may think a stock is going to go up, but on the other hand, you say, well, what if there's a major market decline? This is a great stock, but it could go down too. So you allocate a portion of your portfolio to, in effect, providing insurance against a decline, a large decline.
What do you think people really miss when it comes to the options in this context? People tend to really understand that benefit of hedging. It's obvious, but people tend to sometimes overpay for that insurance. And how should one think about the right price to pay to get that insurance? What are some of the factors?
This is the judgment call that the person makes. I mean, no one's trying to hide anything. The risk is that the stock doesn't go down and you've lost the money and you've got nothing in return for it if you buy a put. And even if the market goes down enough, as I said earlier, you still lose the money you paid for the put. You're never going to get that money back. So you have to make a judgment call. How much is it worth to me to have the peace of mind knowing that the stock I just bought for 100 can never be worth less than $95 to me, or 90 or 85 or 80. And, the price is right there. It's not a secret. And it just depends on the purchasers and his risk tolerance and what he's looking for. I don't think that Warren Buffett ever uses puts. I mean, I think he, for example, says, I'm in this for the long term. I don't want to spend the money on puts. Stocks go down, they do, and I'll stay here until it goes up again. So.
And I'm glad you mentioned Warren Buffett in this context, and I think Warren Buffett referred to derivatives as weapons of mass destruction. People tend to lump options with other types of securities,
options
products.
And futures, right? They often confuse the two, but
right.
there is a similarity.
big
But
differences that one should be aware of.
I would just like to point out that after Warren Buffett made that statement that he thought options were weapons of mass destruction, he sold, I think, a 20-year put on the S&P 500 for some huge amount of money. I don't know, it was millions of dollars I think he took in. So, he has his exceptions too.
What would you say is something that investors need to be aware of in today's environment? I'm thinking about, what some would say an artificially low interest rate environment, or other attributes of the markets today that one needs to be aware of when considering options.
Well, you just take into consideration all the factors that you would in normally assessing the stock market. And today there are plenty of things people can worry about. We haven't really resolved the debt ceiling problem. We haven't really resolved the funding problem, so they're going to come up again. And maybe next time the Republicans will make a stronger case and won't be able to reach an agreement with the president, and the market could face tremendous turmoil again. And then there's the economy. The Fed has done almost everything it can now, and what if things weaken? Is there any more that the Fed can do, or will they be helplessly standing by saying we have done everything we can and we just have to let the economy go down and the market with it? So these are the kind of things you have to think about when you do long-term planning. And by the way, there are puts that go way out for a year, let's say. So if you have these concerns, you can buy long-term puts that will protect your stock portfolio.
Now, when it comes to thinking about your strategy, help us understand what's really that strategy dependent on. How are you using options differently than what we've just talked about, perhaps the uses of equity
Well, we've
investors?
talked about buying puts, covered call writing, but what I do is put writing, and it's basically uncovered, although it's hedged. Now, what does that mean? Well, it takes a little reverse thinking to think about selling a put, because you buy a put if you think the market is going to go down. Now, when you sell a put, it's because you don't think the market is going to go down. And what's interesting is I sell puts, but I don't sell calls. And this is a strategy that has evolved over many years from experience that I've had over the years. Why do we only sell puts? Because puts on the S&P 500, which is what I sell, trade almost always at a higher price than their theoretical value. So if you go to the formula and you take the current implied volatility of the market, which is called the VIX, and you look at a put option, you will see that if you apply the formula of what's the volatility in the VIX and so forth, how far out the money is it, that it is the price of this put is significantly higher than it should be under its theoretical model. Now, this goes on for a long year after year after year. And you say, how could that be? Why would these be selling at more than the Black-Scholes formula tells us they should be selling at? The answer is because of the unique buy and sell dynamics of the S&P 500. If you come to, let's say, take crude oil, there are buyers and sellers, and the producers who own the wells want to keep the price up, so they're trying to lock in a high price by buying puts. You have the distributors, the wholesalers who are trying to get a low price, and the airlines who want a low price for fuel, so they are buying calls, and so on and so forth. And they get to the gas stations, which also want a lower price. So it equals out. You have buyers and sellers, of course, because there's only so much oil, and it has to be bought and sold, and someone's on either side of the trade. However, when it comes to the S&P, what we find is that people are buying puts to protect their portfolios. And as I mentioned earlier, a lot of big institutions, hedge funds particularly, use puts as a way of protecting themselves against major decline. So there's a demand from all the people who own stocks. Now, where would the sellers of puts come from? Well, it would be people who are short stocks. But we know that of all the people involved in the stock market, maybe 2% are short sellers, 3%, some figure like that. It's minuscule. So there are not a lot of natural put sellers. And you have this big demand and shrinking supply, which of course creates a rising price. So I take advantage of that by writing puts, selling them. And we sell them on the S&P 500. There are a number of reasons why we do it on an index instead of individual stocks. One of the reasons is there's more liquidity. I mean, everybody's trading the S&P 500. Not everybody's trading, Kellogg's cornflakes or whatever. So you can get in and out without moving the market particularly. It's a very efficient market.
Now, this is a startling observation, and I struggle to understand then the persistence of that. It seems due to the structural makeup that you've described. So
yes.
Thinking back to the example earlier about the hedging strategy, so there an equity investor is consciously overpaying for that insurance.
Well, he is, overpaying above the theoretical values, but that doesn't matter to him. If I told you that a watch that's selling for $15,000 out here in Madison Avenue at some fancy jewelry store really only costs, $8,000 to make, you'd say, well, so what? I want this watch. It's a beautiful watch. I think it's going to look great on my wrist here, and I'm going to pay $15,000 for it. And that's exactly the case here. So Black-Scholes has their theory, but the real world says that because not many people are put writers or sellers, and a lot of people are put buyers, the price is going to be higher.
Now, give us a sense of when you came to that observation and then implemented the strategy. Have you seen any changes that you needed to make? Theory would suggest that this inefficiency would go away over time.
Well, I know, but it just doesn't. It's one of the, maybe it is not an inefficiency. Maybe it's an inherent part of the option world. And certainly I've been in this business almost 30 years, and I think it's been there, certainly since I've been paying attention to it recently. Well, how we came about to this was through experience. We used to sell puts below the market and calls above it. And we said, well, we're hedged because when the market goes down, we'll lose on the puts, but we're going to make it on the calls. But what we found was it didn't work very well. The calls wouldn't go down very much, and we couldn't get very much money from them in the first place. And besides, the market tends to go up more than it goes down. I mean, all you have to do is look at a chart of the S&P over any long-term basis, and you'll see it's sort of, big drops, 08 and so forth, but it tends to go up. So we decided to stop selling calls and just sell puts. Now that creates another problem, and that is that when the market goes down, you lose money, and you can lose, more than you would like to rather quickly. And this is what puts do. They go up and we're short the puts, so we're losing money on them. So we said we've got to hedge some way. We're not selling calls anymore. What can we do? We came up with the solution of being short futures on the S&P. So the only way we can lose money on our puts is if the market goes down. By selling futures on the S&P, we automatically make money as the market goes down. So that is how we hedge our position. Now, you can't hedge 100% because then you wouldn't make any money really, or much less. So the art in the whole thing comes in how much you hedge, and that's the trick there. What percentage of the value of your puts are you going to hedge?
What would you say is the biggest risk of your strategy?
Well, the biggest risk is a market that goes up and down and up and down and up and down, because we would take defensive action as it goes down, and then if it turns around and goes up, that defensive action would be losing money for us, right? So then we probably buy in some of the hedges, and then it goes up, and well, anyhow.
So sideways markets
not sideways, but sideways volatility. In other words, sideways is fine for us because, as with the passage of time, these options tend to go down. There's a built-in time decay, a half-life on these options. But the problem is if the market plunges down, and we have a lot of safeguards in our program. One of them is that if the option price goes up too much, we will automatically buy it in. So we buy in an option, let's say, at a loss, and then when the market turns around and starts running up, we probably sell it out again at a lower price, and then it turns around again. So that is the worst scenario for us.
You mentioned that it seems almost that equity markets have this natural tendency to go up and up over time.
Well, on a long-term basis, I'm not predicting what's going to happen in the next few years, but there is, there's just no question. You go back 30 years or 40 years or 50 years, any long term, it's startling how much the markets have gone up.
Now, when I asked you earlier about the level of interest rates and the current market environment as an input into considerations about option strategies, I'd be curious to get your view on the following. It would seem to me that certainly given central bank behavior, there's this distinction that investors need to make increasingly about nominal versus real. And it would seem to me that the S&P 500, in an environment like we have today, could in nominal terms easily go up and continue going up materially. In real terms, it may be different, but certainly you would benefit tremendously from a policy that is really aiming at providing liquidity, printing money, making nominal prices go up. It seems that's the world we live in.
It doesn't matter to us what the real economy is doing. We're focusing on the stock market. So you're absolutely right. That's the only thing that impacts us and determines whether we make money or not, is the price of the S&P, right? So not a concern for us.
If we think about, let's say, what can happen to the stock market, let's say in inflationary times, it's essentially, let's say, in relative to gold, the S&P 500, or relative to oil, it may not be changing much, yet in nominal terms, it can be going up drastically. So in a way, do you see there a hidden sort of benefit of your strategy that could
Well, I mean, the stock market does tend to go up in inflationary times. It may not keep up with the inflation, actually, or certainly not with gold or land. But yes, we would benefit from that because we do relatively well when the market is advancing.
So what I'm trying to get at is, have you seen interest from any other types of clients that have come in to seek the benefits of your strategy because of some developments in today's world with central bank behavior the way it is?
No, I haven't seen that. People are focused on our basic strategy, what we do, what are the risks. People are very focused on the risk of uncovered options selling. And we do have a program, a 6-point program to ameliorate the risk. Obviously, we can't predict that we're not going to ever lose money, but we have, over the years, instituted a lot of things that will lessen the risk. And that's what people are interested in. I think if you're worried about inflation, you're probably going to buy gold and forget about our program. But it's a good point you're making that it would benefit.
Now, if we step back a bit, give us a sense of the misconceptions that equity investors may have about options. And I think we touched on some of that.
The biggest misconception, the one that upsets me, is that all the literature on uncovered option writing says there's risk of unlimited loss. Well, I've never seen an unlimited loss in my life. I've seen big losses. I've seen big losses in the stock market. And so I think that this idea that there's unlimited losses is a little too extreme. And then what I think you have to take into consideration is what people try to do to ameliorate the risk. And as I mentioned, we have a number of things we've done. First of all, we're very careful about selecting the puts which we sell. If the market is at 1,700, we don't sell a 1,700 strike price put. We don't even sell we may sell a 1,600 strike price, but it's 100 points out of the money. But frequently we'll sell a 15-something, 1560. So at least at the expiration date, the market would have to fall almost 10% for us to get stopped out. Now, actually, it wouldn't have to fall 10% in the first week or something, but that gives you an idea of the amount of built-in hedge we have by having strike prices that are way below the current price of the market. And then, as I mentioned, we have an automatic trigger that gets us out when the options move against us too far. And we write short-term options, so, which means that they're going to expire in a couple of weeks anyhow, so they can't go up too much in price, or they're unlikely to.
Have you ever been tempted to look at other markets in the world to exploit your strategy? And can you give us a sense of the U.S. Equity and option markets relative to other markets in the world? What's perhaps interesting
that's
there?
A very good point. And there are options markets all around the world now. The reason we haven't done it is that what we would love to do going around the world is to get diversification against risk. But the only diversification we really need is in case of a major drop down. And we're living in a globalized world now. And if the Wall Street plunges, London's going to do it too, and so is Japan. What happens on Wall Street in the afternoon is right there in the Japanese market within a few hours when they open. So it's an interlocked world, and therefore we really haven't pursued it because it wouldn't help us very much.
Now, you've been studying options, you've been successfully investing with option strategies for decades. I'd be curious, what developments have you seen that perhaps could lead to new inefficiencies out there in the options market? Or have you found that as the markets are getting more sophisticated, there is less and less inefficiency?
Well, I think, if anything, more people are writing options. The last couple of years, we haven't really seen a lot of volatility, and we've been seeing an up market pretty much, certainly the last 2 years, and so option prices have come down. And the option prices are really measured by the VIX, and as we conduct this interview right now, the VIX is at 12. Well, the range for last year has been from 11 to, I don't know, 30 maybe, or something like that. So it is at the bottom of the range right now, and that's a negative for us. When we sell options, we're not getting as much money as we used to. Now, on the other hand, that's offset by the fact that the trend in the market has been favorable to us. Hasn't been too volatile. We haven't seen too many major declines, and actually the market's been moving up. Of course, that doesn't mean it's going to continue, but that's the state of options right now.
To come back to equity investors who are interested in options and understanding the various strategies, you mentioned the VIX several times. I'd be curious if you could tell us a bit more. What signaling effect do you derive from the VIX, and what perhaps equity investors could use the VIX for,
Right.
and what are perhaps some of the misuses?
Well, the VIX is known as the fear index. This is its popular name, and there's a lot of truth to that. Because when people get afraid, they rush into the market to buy puts and push the price up further. But we have found that it's not a predictive index. It's a coincidental index. People get afraid after the market's going down or as it's going down. So I think anyone who tries to use it simply to predict what's going to happen is it's not going to be a very particularly successful means, but that would be one way. So from our point of view, we watch the VIX because it determines what prices we can get, but there's not much we can do about it. So if it goes down, we adjust the options a bit that we're selling, but we have to. We're not market makers, we're market takers. And there are the prices, and we call up the floor of the exchange and say, what is the 1600 put for December selling for now? And we can either sell it or not. We don't have any choice in saying, gee, this is too low.
If I'm an equity investor and I see that the VIX is in the low teens, that's when I want to be buying puts.
Well, maybe. You think it shows that people are overconfident, too complacent. Yeah, that's a theory, but doesn't mean that the market isn't going to continue or that it can go down from 12 to 11. I mean, there have been years when the VIX was down at those levels. Predicting is very, very tricky. And luckily, in our strategy, we really don't have to do much predicting because, as I said, we have this wide latitude. We sell strike prices that are significantly below the market, some short-term options, which are going to expire sometimes in 3 weeks. So if we make a mistake or the market goes down, the option expires anyhow, and then we can sell one further down when 3 weeks are up. So we have a lot of flexibility.
What would you say are the personality traits that make for a successful investor in option strategies? Could you perhaps describe a little bit the mindset of an options investor?
Well, it helps to have a sense of the probabilities of the market. What is likely to happen? We don't try to predict that the market's going to go up or that it's going to go down like so many commentators do. And when you're trading on the S&P 500 index, you don't have to predict which stocks are going to outperform which stocks. So that's a big plus for us. So I think basically, well, that's
I'm trying to get at what it seems that folks tend to think about mathematical mindsets that are needed
right.
to
Well, you
approach options.
but you don't really need a mathematical mind. I mean, you just have to say to yourself, well, we know that when we're trading futures options, every point that we take in is $250. And you say, well, what are the chances that the market's going to go down enough so that we will get stopped out of this position or lose money on it? You have to have a sense of the probability and proportion, what is likely to happen. I think that's the important thing. The other mindset you need to have is that losses come with the territory. If there were never any losses, everybody would be rich and the whole world would be selling options like we are. But it does happen. It hasn't happened in a while, actually, but you have to be willing to accept losses.
Now, you've been in the business for decades. What advice do you have to investors who are perhaps new to options, who understand that options have certain benefits, but they're just unsure how to approach the subject? And you've written a wonderful book, pioneered the instructive discourse about options. So tell us a bit about what resources you would direct people
to. I believe that people with any knowledge of the market can write covered calls as long as they're aware, as I mentioned, that they could be losing money in an up market. It's not a guarantee of added funds or added money. In the many sad cases, people were amazed that they had to put money in to a call writing program. Secondly, if you want to buy puts, that's something anyone can do. Know what the expiration date is, compare different expiration dates, see on a, let's say, per week basis, how much are you paying? It could be that you'll be saving a lot of money by buying a 6-month option instead of a 1 month on a per week basis. So that's the important thing there. Now, when it comes to writing uncovered options like what we're doing, I don't want to be too promotional minded here, but I think it would help people to seek the assistance of a professional, because there is a high degree of risk, and that is pretty complex. I mean, picking the options and then hedging them, and the combination of the two is a fairly complex operation, and that's what we do. However, when it comes to uncovered option writing like we do, I think that most investors should seek the advice and help of a professional, because it is quite complex, and especially with the hedging aspects, it's not something that people can learn quickly.
And of course, the performance will vary greatly for different types of investors and different levels of experience. Tell us a bit about your strategy then. What was the performance over the period that you've employed it?
Well, our performance since our inception has been very good. We have outperformed the S&P 500 significantly, which most managers don't even get up to the S&P 500. That's considered a major success, and we've outperformed it. So I think that's the main attraction of why people are attracted to what we're doing. Two things. It's a way to get diversification of your exposure to equities. And secondly, in many markets, we outperform the equity markets. For example, we were up 31% last year, and we're up 15% this year. So we have very good returns. And because of the way we do it, there are tax benefits, major tax benefits for tax-paying investors.
Now, for someone who would say that, well, can you describe the risk that you took to achieve that performance? How would you describe that element of the risk-return equation?
Well, as I mentioned, the risk we have, not so much a drop in the market. We would have a loss if the market just dropped, but it wouldn't be so great. It might be, well, I don't know, a few percentage points, let's just say. The risk is, as I said earlier, that then after the market goes down, it goes back up again, and then it goes back down again. And if that repeats itself, oh, actually, we'd probably withdraw from the market. But it could be, that's the risk, one risk we face.
Are you ever worried that this strategy may become more crowded, that, it's, how do you explain that perhaps there haven't been more people who have adopted your strategy, and as a result, the performance would dissipate over time?
Well, you're right. And we saw that a number of years ago. It was very profitable, and a lot of people got into it, and everyone who had tried it said, this was in the in the beginning of the 2000s. And so there were a lot of people who got into it, thought that brokers, stockbrokers who did it a little bit on the side and said, wow, we're making so much money, let's get into this and do it. But when '08 came, a lot of people found out it wasn't so easy. And we were down, but in line with the market. But many people more or less blew up or lost everything in '08 because of such drastic moves in the market. So it's a bit self-correcting there. And I suppose there will be more people, but that's the way it is. The other thing is, it's really not a popular strategy. Most people don't like options. They have an instinctive, they want something solid, which they say is solid, let's buy dividend-paying stocks, names we know. Well, that gives people a feeling of security. What we do is so complicated, or to many people is different, that it's hard for them to get that same feeling of security. So that limits the number of people who go into it.
Well, I certainly got the appreciation for what it takes to be successful at the strategy that you employ, and I hope that we've done a little bit to further people's awareness of your strategy, as well as the benefits that can accrue from it. I want to thank you so much for your time and the incredible insights and experience that you've shared with us here today.
And I do want to add before we end that I must say, required to say, I guess, that there is a risk of loss in all options trading, and that everybody should read the options prospectus before they trade, which is available from their broker.
Max, it was a pleasure. Thank you so much for your time and all the many insights.
So thank you.